Hello and welcome everyone. Good evening. Thank you for joining us this evening. My name is Adil Abbas and I'm a licensed financial advisor and co-owner of Own Financial Planning. Joining me today is my business partner and co-advisor Dane Pimble. We also have our mortgage broking partner Rory Circum from Own Home Loans joining us today as well. Some housekeeping before we begin. We like to keep these workshops interactive, so please do participate via chat or going off mute during the workshop when we stop for a conversation. Encourage everyone to try and turn on the camera. This will make it a more human experience for all of us. And we'll have some time for Q&A as well. So before we get started, please note that any opinions or any recommendations we discuss today would be general advice only. If you wish to act upon anything you hear about today, we strongly recommend seeking advice from qualified professionals prior to making a decision. So now that I've made our legal and compliance team happy, we can get started. So in our view at Own Financial Planning, the financial planning process itself is similar to somebody renovating their house. It's about getting your financial house in order. And the foundation of this house, in our view, is the client's goals. And we always start with client's goals first. Once we have clarity on the goals of our clients, then we can start to develop strategies aligned to the various rooms in this house to help them achieve their goals. Now, typically for many of our clients, tax planning is a critical pillar of the overall strategy. And this is what the focus of our conversation will be this evening. Now, not sure how many of you have been following the budget announcements from last night, but there is some good news for all of us. We will all be paying less personal income tax starting from 1st of July, 2024. Now, rising interest rates, energy bills, food cost, the cost of living has become really real for many people, and these tax cuts are a way by the government to relieve that cost of living pressure. Let's look at some key insights as to what are some key changes which are going to come into the personal income tax rate starting from 1st of July. So firstly, the tax rate on income between $18,200 to the $45,000 bracket goes down from 19% to 16%. The tax rate on the income slab between $45,001 and $120,000 actually goes down from 32.5% to 30%. The upper limit for the 30%, which you can see over here, which was previously 32.5%, also will be bumped up to $135,000. The upper limit for the current 37% tax bracket will be bumped up to $190,000. As you can see here, it used to be 180, now it's to 190. And the top marginal tax rate stays at 45%. However, it now applies to incomes over $190,000. So really, there's something in it for everyone, as you can see over here. And to make this even more real for all of you who have joined us today, we've done some quick calculations for you over here. So on this slide, you can see that the annual tax cut at various incomes ranges from $800 for someone earning $45,000 all the way up to $3,700 for someone earning $150,000. So key point to note, if you are an employee or a business owner paying yourself a monthly salary, you should see a change in your first take-home pay after 1st of July 2024. Now, employers are required to use the new tax withholding rates as soon as they take effect. However, keep in mind that sometimes there can be a short transition period to allow employers to update their payroll systems. However, one key tip over here, if you don't see any change, do check with your payroll or HR department so that you don't really try to miss out on these tax cuts. Now, this is at a general level. Now, we know many a times clients are very keen, and I'm sure all of you are keen to really know how much is this going to impact your own take-home pay. So let's first of all, to kick off, let's do a quick exercise. We suggest everyone who's on the line, please go to this particular link, enter your annual income enter your expected annual income or current annual income on that calculator and find out how much is your tax bill going to change. And then once you've done that, tell us in the chat or go off mute and really share with us, what are you going to do with that extra money? Is it going to go towards a small holiday, pay off the credit card, pay off the home loan a little bit there? Tell us. There are no right or wrong answers here. So I'll give everybody 1 or 2 minutes just to go to this link and try and put in their income tax number there.
Are we allowed to have holidays at Own Financial Planning a Deal? I'm not sure if I'm allowed to or not to get permission.
It's part of our goals. It's part of the annual goal setting. Anyone brave enough to tell us what are they going to do with their tax cut? Put it in chat, go off mute. Very keen to hear what people have got on their agenda, on their list. Vicky.
I'm sorry, Aadil, I'm actually finding it hard to find where the link is. I haven't found the link.
Oh, the link is on this particular slide. It's taxcuts.gov.au/calculator, or you can just go to taxcut.gov.au and there'll be a calculator there on that link. Is anybody else having the same issue with this link? Or
I just put it in the chat, Aadil.
Oh, great. Thanks, Rory.
Great minds think alike, Rory.
Thank you, Rory. Rory, what are you going to do with your tax cut?
I was just typing. I feel obliged to say I'm going to take it off the mortgage, but yeah, it's a nice little kick, isn't it? You get maybe a little holiday be nice, but yeah, I'm sure I'll find something to do with it.
Too much to do, Ildi. If you could pick one, do you have a preference?
Oh well, for us it's simple because my sister and her family are coming at the end of the year, so a bit of extra money will actually help in having a bit more fun.
Right. Yeah. Absolutely. And we always encourage our clients to try and strike a balance between trying to kind of enjoy the present and also kind of try and save for the future. So it's good to see people are having different ideas over here. Like I think Ildi, for you, it's about using that time to splurge on family a little bit. For Rory, it is paying the home loan. So people are trying to strike their own balance over there. So thank you everyone for just giving this a go.
School fees for Shane. We'll talk a little bit about that one actually a bit later and in an upcoming workshop that we're going to have an actual session right specifically on that topic.
Great. Okay. So thank you, everyone, whoever kind of gave this a go. Hopefully, this is a useful link for you as you go into the next financial year. I would suggest saving the links in the future when you get your take-home pay. Maybe you can try and compare and make sure you're getting the benefit of the tax cuts. So these tax benefits are locked in for you for the next financial year. What we wish to talk about next is what can you do to maximize your tax benefits for this financial year prior to 30th of June. And we'll talk about 3 strategies which can help you do that to even maximize tax benefits starting for this financial year. So our first strategy, and I'm just, our first strategy is really around making personal super contributions over here. So there's the slide has a fair bit of information on it, and I will walk you through the slide. So let's take the example of one of our clients. We'll call him Bob. Bob is 45 years old. He earns an income of $100,000, as you can see over here. So as you can see in this particular column, Bob gets his guaranteed employer contributions currently for this financial year, and that's at 11%. He gets $11,000. He does not make any personal contribution in addition to this. So his taxable income remains at $100,000. That gives him a tax bill of $25,000 for this year. Now let's see on this last column over here what happens if he was to make an additional contribution into his super. And you can see over here that if he makes an additional contribution of $10,000 into his super, that gives him an instant tax deduction and reduces his assessable tax income to $90,000, thereby bringing his tax liability down to $21,500. He has saved $3,500 just by doing this. Now that's not a bad return, we would say, saving $3,500. By doing this, Bob, as you can imagine, has not only increased his retirement savings, but also improved his present financial situation. So a key consideration we would suggest prior to implementing a strategy like this would be to ensure that you do not need this money or any money being additionally put into super. You are not needing it right now, and you will not need the money until you access your super. So not a bad way to get started in terms of making a personal contribution and the benefit of doing that. Let's delve a little bit more into the rules around implementing this particular strategy. So now a lot of you on this line may be familiar with the term super concessional contributions. Now, essentially, these are contributions into your superannuation fund, which are taxed at 15%, which in Bob's example is lower than his marginal tax rate of 32.5% this financial year. And your concessional contribution limit is made up of all contributions made by your employer and any salary sacrifice arrangement you may have towards your super, and they're all considered as concessional contribution. However, there is a limit to how much you can contribute concessionally and be taxed at a lower rate. And the limit for this financial year, is $27,500. From next financial year, actually, this limit goes up to $30,000. So let's continue with the example of our client, Bob. So Bob's got a limit of $27,500. We saw previously that he makes a contribution of $11,000, thereby giving him what we would call as an unused concessional contribution limit of $16,500. And we saw on the last slide that by making a $10,000 contribution, Bob is well under his concessional contribution limits, and that allows him to be able to get this particular tax deduction. There's another interesting element when it comes to concessional contributions, and this is applicable for people who have a super balance currently of less than $500,000. People who have a super balance of less than $500,000 can avail of something what is called as catch-up concessional contributions. Now, these are essentially your unutilized concessional contribution limits from the last 5 financial years. So in our example, let's say Bob had implemented the same strategy in the last financial year as well. He would have an unutilized concessional contribution balance of $6,500 from last year, which he can utilize over the next financial year if he has surplus cash flows to do that. Key point to note over here, the key criteria being your super balance has to be less than $500,000 over there. So that's a lot of numbers. And if you decide to implement this particular strategy, it is critical that you do these things in a certain order so that you can get the tax benefit. And on the next slide, I will walk you through the key steps which have to be done in order for you to get the tax benefit ultimately by making this particular contribution.
So Aadil, we might just pause there for a moment. Susan's got a question.
Oh, sure.
Just regarding concessional contribution. So her question's what happens if you happen to contribute over the limit? And as you would know, we see this happen quite a bit, particularly for clients who have salary sacrifices set up automatically with their employer, and when their salary goes up, sometimes that bumps them over the limit. Did you want to comment a little bit on that?
Sure. So Susan, essentially what happens is if you go over the contribution limit, the excess sort of contributions will not be taxed at the 15% tax rate. They'll be taxed at the higher, I would say 30% tax rate. So if you are, which is not the end of the world, because if you are at a high income earning and you're paying tax rate at 42%, getting taxed at, I would say 30% is still tax advantageous to you. You just don't get the concessional treatment. There is an implication around total contributions going more than 27,500, and there's a concept called Division 293, which we will try and speak about in a different conversation. But so essentially, you have to think about: is the 30% tax bracket still lower than my marginal tax rate? Think of it that way. Not the end of the world, we would say, but it's again linked to your goals, whether you'd like to do it that way. Nick had a question around what happens if you have more than $500,000. So Nick, in that case, the only difference over here is that you would not have access to the catch-up concessional contributions. You still have access to your concessional contributions limit each year, which is $27,500 for this financial year. And you still have access to the super balance limit, which is $16,500. So essentially, you have to think about: am I going to be, is the 30% tax bracket still lower than my marginal tax rate? Think of it that way. Not the end of the world, we would say, but it's again linked to your goals, whether you'd like to do it that way. Nick had a question around what happens if you have more than $500,000. So Nick, in that case, the only difference over here is that you would not have access to the catch-up concessional contributions. You still have access to your concessional contributions limit each year, which is $27,500 for this financial year. and 30,000 for the next financial year.
That could be a great one for people who might have taken some time off work or a career break where they're not actually having their employer contribute for them. So that you've got, I think it's up to 5 years, is that right? A deal of unused contributions from prior years, whilst your super balance remains below 500,000, you can.
Absolutely. Last 5 financial years, correct.
Yeah. And Samuel has a question around whether this is a separate cap from the compulsory super. So I mean, essentially, if your salary income is at a level where your super contributions are already hitting that cap, then you're not in a position where you can actually utilize additional additional concessional contributions. It all forms part of the one cap. So for clients on higher incomes, we look at different strategies, potentially non-concessional contributions for those that are closer to retirement, or there are other structures outside of super that we'll talk about in upcoming discussions, such as investment bonds, that can be quite tax effective for those that are already exceeding their or meeting their concessional contribution limits.
Great questions, everyone. I think it's really good to see that everybody's trying to apply this to their situation and thinking about how they could take advantage of these sorts of tax strategies. As I mentioned, it's important that if you would decide to implement this particular strategy, you do certain things from a compliance perspective in a certain order. And I'll just walk you through the steps on the next slide as to in what order you have to do these steps in order to get the tax deduction or the tax benefit. So let's just.
Yes, Susan, to answer your question, yes, we will.
Okay. Okay, so first of all, step number 1, very basic, make a personal contribution prior to 30th June 2023. Whilst it sounds very simple, it is important that you actually don't leave it right until the very last day, because the money needs to be in your super fund by this particular date. So we strongly recommend you call your super fund to check on their I would say, cutoff date, as you need to account for account for transaction processing times. So please do not leave this right until the very last day. If you decide to implement the strategy, try to do it a few days in advance and talk to your super fund. Step number 2, once you've done that, you need to lodge a form, which is called a notice of intent, with your super fund soon after making the contribution. The form is easily available on the ETO website, or you can ask your super fund for the same as well. So that's step number 2 in this process. Step number 3, await to receive an acknowledgement letter from your super fund, which typically comes once the super fund is processed. We see typically it can take anywhere between 4 to 6 weeks for this, I would say, letter to arrive. It can take longer depending on your super fund. However, this letter is very critical, because only after you receive this letter and only after that, please lodge your tax return and ensure that you provide this acknowledgement the letter to your tax agent or your accountant so they can claim the contribution as a tax deduction. So do not rush to lodge your tax returns until you have this acknowledgement, I would say, letter, and make sure to do the earlier steps as well. This is very critical. We see this happening a lot of times. Clients actually end up making the contribution and they want to lodge their tax return straight away, maybe sometimes on 1st of July, and they miss out on actually claiming the deduction. So it is important that these steps are followed. Again, as we mentioned, please talk to a qualified accountant, tax agent, or a qualified professional when you implement this particular strategy. So that was strategy number 1. Let's look at strategy number 2 now. And strategy number 2 is about prepaying certain tax-deductible expenses prior to 30th June. So in this example, we've got another of our clients. We'll call her Beth. Beth is 50 years old. And this year, Beth actually got a nice performance bonus that took her total income to $190,000 because of the bonus. Now, Beth also owns an investment property and she has income protection. She has income protection insurance held in her own name. So what are some options available to Beth in terms of tax-deductible expenses she can consider to reduce her tax bill? Let's start with the investment property. Beth could potentially look to prepay 12 months of interest on her investment property and claim the entire 12 months interest as a deduction. Or she could look to bring forward any repairs she was planning to make as well. So some sort of investment property expense which is tax deductible can be brought forward if you want to claim that as an expense. She has also got an income protection insurance. She pays premiums for that, which is held in her own name. She could consider prepaying her income protection insurance premiums for 12 months in advance upfront rather than paying them month by month. And finally, and she was also making some charitable, I would say, donations, she could consider bringing forward her charitable donations. Instead of paying them month by month, $100, she decides to bring forward all of them and pay for 12 months in advance and pay them all in advance. So when you add up all of this, you can see that by prepaying certain expenses of up to $13,700, Beth is able to claim a deduction for these expenses, and that brings her assessable income down to, from 190, it comes down to 176,300, which thereby what that does is essentially she is saving $6,200 in tax. She was up for a tax liability of 60,000. Now she's up for a tax liability of 53,800. Again, so spend 13,700 and she saves 6,200 in tax. Not a bad outcome again. You will see on the bottom left of the slide as well that the same strategy, when applied in the next financial year, brings about a slightly lower tax saving of 5,200, and this is due to the new tax slabs. So right now, because we are on the higher tax slabs, it's a much more tax effective strategy for this particular financial year, but will also be effective next year, but slightly less effective because of lower tax slabs. So this is for Beth, who is an employee. We've got some additional, I would say, considerations. If you're a small business owner, there are a few other things you could potentially try and think about in this particular strategy. So I'll talk about these certain expenses which are available to small business owners. So if you are a small business owner, some of the additional things you could consider as part of prepaying expense strategy is write off your bad debt. Just simply trying to, I would say, write off your bad debts. You could also consider writing down your stock in hand or work in progress to its current market value if it is lower than the cost price. That can also, you can claim as a deduction. There's some small business owners who are on the line today with us would know about the instant asset write-off asset benefit of less than $20,000. What this essentially means is that if you buy and install an eligible asset used for your business, so for example, a new laptop prior to 30th June, you can deduct the entire cost in your tax return for this financial year. And very interestingly, this applies on a per asset basis. So you can instantly write off multiple assets, giving you even a greater deduction. Now, this measure was going to expire on 30th of June, 2024, but in last night's, I would say, budget, this has now been extended for another year until 30th June, 2025. And then finally, if you are a sole trader business owner, it may be worthwhile for you to consider delaying some income or invoices to July 2024, which is the next financial year, to take advantage of the lower tax rate, which we discussed earlier tonight. So bring forward expenses, push back income, just to take advantage of different tax slabs in each of the financial year. As we said at the beginning, please do consult a qualified professional before implementing any of these strategies, because there are nuances around each of these things, and it's best for you to get considered advice as you think about implementing this strategy. Dane, did we have any questions on this particular one right now, or any comments on this particular strategy?
No, not at this stage. I think you can roll on to strategy 3, and we can always pick them up.
Sure. Do you want me to make a quick comment about the interest in advance on the loan from the last?
Go for it, Rory.
Sorry,
No,
it's just, there's specific products. If you want to take that advantage of being able to pay interest in advance on an investment mortgage, you really need a specific product to do that. So if you're thinking about doing that, reach out really, really soon to discuss that strategy, because it does involve setting it up with your lender. So I just wanted to make that clear.
Great. Thank you, Rory.
Thanks very much.
Okay. coming to our final the third strategy, or the final strategy, which we would like to kind of share with you for today is around spouse contributions into super. So here again, we have another of our clients. We'll call them Steve and Sarah. Now, Steve and Sarah have 2 young children. And last year, Sarah decided to cut back to working only 2 days a week. So she's now only earning 32,000 per annum. Now, as a result of this, as you can imagine, Sarah's employer super contributions are going to be much lower than they were in previous years when she was working full-time. So to mitigate the impact of this on Sarah's retirement saving, Steve contributes $3,000 into Sarah's super account, which gives him a tax offset of $540, whilst ensuring that Sarah continues to build her super. Now, there are some criteria which must be met, and we've outlined these on the right for you. But essentially, this strategy applies when your spouse earns less than $40,000 per annum and you are able to contribute up to $3,000 to get the maximum tax benefit. So this is a fairly common scenario we see with many of our clients when people have kids and one of the spouse decides to take a bit of a career break. This is a good way to balance out and ensure that your spouse's, I would say, retirement savings you're still investing in their retirement fund. So really, we have shared, I think, the 3 strategies we think are the top 3 strategies which people can consider. We'll stop here and happy to take any questions before we move forward. So please feel free to put your questions in chat, go off mute and ask a question, and then we'll proceed from there. After this, Dane will share a little bit more about our advice philosophy and how we work with our clients.
And if there are any sort of strategies that we haven't covered that you might consider that you wanted our sort of opinions on, obviously feel free to pop them in the chat too.
Might go off mute if that's all right. Just for my question. With this spouse contributions, I'm assuming there's the similar sort of time frame to the previous one. You've got to do it before June 30, and it's time dependent.
To get the tax deduction in this financial year, yes.
Yes.
Yeah. And 3,000 is the maximum.
3,000 is the maximum you can get, actually. Yes, that's the max.
Yeah.
Sorry, 3,000 is not the maximum you can contribute. The maximum tax offset you will get is 540. So 3,000 is the ideal amount to get the maximum tax offset.
Can obviously contribute more if you've got pooled savings, but you won't get the tax offset in your personal return.
Yeah, understood. Thanks.
And I mean, naturally, obviously, that can still be beneficial long term, in that you're still getting more funds for husband and wife into a more tax effective environment. Any other questions?
Dane, any questions, Dane? Or
no, I think that's all. We might sort of jump across.
Sure, let's do that. I'm going to hand over to you, Dane, to kind of bring us home.
Sure. Thanks, Aadil. So at Own Financial Planning, we've got one pretty simple mission for how we help our clients, and that's essentially the perspective that life is more than money. And really, money it's simply a tool that enables you to live your best life and leave a legacy as well. So in all of our advice, we aim to align the money decisions with your life intentions. So we absolutely do all of the investment strategy stuff, just like any financial planner does, but rather than that be the specific focus, it's certainly part of the advice outcomes that you receive, but the focus is very much about the life that you want to live, the goals that you're trying to achieve. We understand that first, and we map the strategies out to work towards achieving those life objectives. And so the basis behind our advice approach is centered around renowned academic Dr. Margaret Swarbrick's research on the 8 dimensions of well-being. Money essentially being just one, part of what makes a fulfilling life. We've got physical, spiritual, social, emotional, intellectual, occupational, environmental, and financial. And obviously, traditionally, financial planners have provided advice around that one part of your life. Importantly, it could be a non-financial thing that's holding you back or sort of making you feel a bit stuck, that may be affecting the financial part of your life. So we really truly want to understand where everything's at, what's working, what's not, and we believe that overall well-being is a healthy approach to living. And it could mean doing purposeful work, enjoying good relationships, eating well, having a work-life balance, and essentially financial freedom. And it can be different for everyone. And so as part of preparing our advice, we really aim to find out what it means for you. So how do we do that? So we start by understanding where you're at in life today and what your priorities are right now. And so the Your Life survey that we provide is a questionnaire that's used to find out and measure what's important to you and to understand how you feel and how you're currently tracking. And once we understand the areas of your life that need immediate support, we then dig a little bit deeper. And through our discovery process, it helps you and us to identify what's important to you at an individual and at a household level through a values exercise. And so our aim with that is to empower you to live your best life by aligning your wealth with your values. So once we have that understood, we then work to set SMART goals. And so SMART stands for specific, many of you would be familiar with this term, but for those that aren't, it's specific, measurable, achievable, relevant, and time-bound goals. And so if one of your values, for example, is to educate your kids or your loved ones, a SMART goal could be to pay for your children's university education, and detailing when you need to achieve this by, how much money is required to cover the cost, and is it even possible when mapped against everything else you want to achieve? And goal priorities like that is a really important context as to how we frame not just the advice itself, but the process and the steps as to how we work with you to implement the advice. And so we know that, if it was easy, everyone would be living their best life and everyone would be doing that. But even when life's unpredictable, we can help through providing ongoing service to help you adapt your plan along the way to ensure that you're continuing to live well. And so our Best Life modeling tool, it lets you know if things are going okay, both now and into retirement, or what areas need the most attention right now. And like we mentioned, sometimes they're not necessarily financial areas that need that attention, but at least identifying that and working with the team of professionals that we have around us can help get you unstuck in those areas. So we aim to keep you accountable, and that's a really important part of the service that we provide, and working in partnership with you to create the life that you've always dreamed of, and even better, that you can log in and access your financial plan from anywhere at any time. So this means that you can keep track of the tasks and the goals that are required or the tasks that are required to achieve your goals. Upload any necessary documents to share with us as your advisors, or test out the scenarios to see how they are going to impact your best life. And we don't just talk about this well-being stuff. We are truly adopting an integrated approach to help you live your best life. And how we do that is by connecting you with the relevant experts to improve your overall well-being. And so, as you can see on the left there, we partner with the specialists in all the traditional areas any financial planner would in respect to legal, insurance, accounting, property and lending. But importantly, we also partner with specialists in the non-financial fields. And obviously, with lending, we've got Rory on here, who we work very closely with. And in the non-financial fields that help you in the other areas of well-being, we've got relationships with mental and physical health specialists, business and career coaches, and some of them are on the call today with us. And thanks for joining us, Ildi. And we can also cater for many other lifestyle needs. So we ensure your financial plan provides for investing in your overall well-being, not just the financial aspects of it. And it helps to avoid the guilt of spending in the present whilst worrying about whether you're going to have enough for the future. So that's essentially all we have for today, and hopefully you've found the session informative. And I'll open it up if we've got any more questions whilst we're still here. But whilst I've still got you all, we wanted to let you know of some of the exciting guests that we've got coming up in upcoming events. So in June, we're going to have globally renowned career coach Preena Shah, who's going to discuss with us how to get the most out of your career, and in particular, how to go about asking for a pay rise, which is, I'd imagine, pretty relevant right now with rising costs. In July, we're going to have Michael Yeager from Generation Life discussing how you can utilize investment bonds in quite a tax effective way in a range of different ways, but in particular, how to help your kids get ahead financially. To your point, Samuel, that you mentioned earlier around when you're capped out on maximising your concessional contributions, I encourage you, if you are free in July to join this session, because investment bonds can be really relevant in that situation. So in August, we're excited to have applied psychologist Bronwyn Penhaligon join us, and she's going to discuss some practical tips around working on your mindset, particularly in its relationship to money, and improving that, like practical tips to improve that overall relationship. Often it's the thing that holds us back the most, more so than the practical limitations of present finances. And so if you would like to take the first step in unlocking how you're tracking towards living your best life, then we have a survey, a short questionnaire. It only takes 5 to 10 minutes for you to complete, and it's on the screen there. And I think, Aadil, you're going to pop the link in the chat. Is that right?
Yes, we'll do that as well.
Thank you. So this survey is going to get to the heart of what it's all for from your own perspective, and it's going to enable you to have more meaningful conversations about life and money, and it will give you the results instantly. Just make sure when you complete the survey that you hit save, and if you would like to then take the next step, you're more than welcome to book in a time for a complimentary debrief session with one of Aadil and myself. So we'll make sure that we send the links to that survey in the follow-up. And to Susan's point earlier, we'll absolutely have the slides available too. We can show you how you can book in a time for one of those sessions with us. And yes, we often get this. We understand some of you might be thinking, why is this all free? What are you trying to sell me? And we essentially, we know that, and we're very grateful. Some of our existing clients are on this workshop. We appreciate having you here as well. But for those that aren't clients, we know that a certain number of you after that session will want to help. We'll want our help in implementing that plan for you. And if that's you, fantastic. But if not, totally fine. At least you'll walk away clearer around the next steps needed to build that plan. Due to our commitments for existing clients, we've only got a number of those spots available each month. So essentially it's first in, best dressed. So that essentially completes the formal part of the workshop, and really appreciate you all investing your time this evening, and hopefully you got some practical tips that you can take away ahead of the end of the financial year, and obviously into the next year as well. So we've got some time for questions. If you've got any questions around tonight's workshop, or broader advice in general, feel free to speak up or drop them in the chat now. But otherwise, thank you all for taking out the time tonight to invest in your education around tax.